Define the difference between Volcker and Brainerd inflation. What's different with this 7-8% versus a 7-8% when you were certified at Berkeley?
I think the difference is that the inflation that Volcker had to fight built up over a long period of time. And so inflation expectations started to rise pretty significantly. So it's much harder to get rid of the inflation than the inflation we have now. The good news is that the inflation expectations are still relatively well anchored. So that would imply that the Federal Reserve isn't going to have to do quite as much to push inflation back down.
Your line in your piece this morning in the lead paragraph, Bill, I think has got everyone's attention, so I'll repeat it for everybody who hasn't heard it so far. To be effective, it'll have to inflict more losses on stock and bond investors than it has so far. Bill, run us through financial conditions and how you gauge financial conditions and why you might believe that stocks are a big part of that.
Well, financial conditions are important in the United States, and Chair Powell has emphasized this in his prepared remarks because that's how monetary policy works. The U.S. economy doesn't really run on short-term interest rates. It really runs on long-term interest rates, and the stock market is also important because a lot of people have exposure to the stock market, and the level of the stock market affects their wealth. So the Fed has said pretty clearly we need to tighten financial conditions to slow the economy down to keep inflation in check. And so far, financial conditions really haven't tightened very much. The stock market is only 4% or so off its high. It's still up very sharply from where it was a couple of years ago. And bond yields, 2.5, 2.6%, are still really low, especially when you adjust for inflation. So in my mind, the Fed hasn't really accomplished much yet. And if financial conditions don't cooperate with the Fed's going to have to do more until financial markets do cooperate.
Bill, talk a little bit about the consequences of this. If stocks are a reflection of sentiment, if they affect the way that people are willing to go out and make purchases based on their household wealth, what does that do to the economy? Are you basically saying that if things continue the way they are, the Fed is going to have to torpedo growth to a potentially recessionary degree?
Well, the Fed right now is, markets are pretty confident in the Fed's program because they have the Fed taking the short-term rates up to about 3%. That causes the economy to slow, and then the Federal Reserve eases policy in 2024 and 2025, and we have a soft landing and live happily ever after. I don't think it's going to be that easy because the markets are so confident in the Fed, the financial conditions are still quite buoyant. If financial conditions are buoyant, that means the Fed has to do more to slow down the economy. Also, a soft landing is very, very hard to achieve when the unemployment rate is so low. The soft landing examples that Powell has cited, 1965, 1984, 1994, were all examples where the Fed tightened and the economy slowed, but did not slow sufficiently to push up the unemployment rate. The unemployment rate in all three of those episodes kept declining. I think in the current environment with the unemployment rate at 3.6% and wages running well above a rate consistent with 2% inflation, the Fed's going to have to tighten financial conditions enough to push up the unemployment rate. And when the Fed has done that in the past, it's always resulted in a recession. That's not their intention. They'll go for a soft landing, but their chances of pulling off are very, very low.
Do you think that rapidly reducing the balance sheet, Bill, will be enough to achieve this sell-off that you think is necessary in order to enact some of the tightening that the Fed is trying to achieve?
Well, certainly we'll work in the right direction. Obviously, quantitative easing helped pull down long-term yields, and I think as you reverse course, that should push them up. But we don't know by how much. We already know what the Fed's going to do, and markets haven't really moved very much. So, I think it's just a big wild card in terms of how much will the quantitative tightening do the Fed's job for them. I think the big point I would just make is just it's very unlikely that a year from now we're going to be at this level of bond yields this low and this level of stock prices this high, because that's probably not sufficiently tight financial conditions to do the Fed's job for them.
Bill, parse the difference as inflation comes down of the importance of goods inflation coming down versus service sector inflation coming down.
Well, obviously, both matter. I mean, I think where the Fed's expectation is that goods inflation will come down quite a lot over the next year because the composition of demand as the economy reopens will shift away from goods back to services. And the fact that some of these supply chain disruptions, for example, in the auto sector, will gradually get resolved. And so car prices, for example, will be weaker. Used car prices will be weaker. But the services sector inflation is going to be a lot more persistent because that's really about labor costs. And we're seeing that labor costs are going up because the labor market is unusually tight in the current setting.
Bill, why don't Fed officials, when they're in the seat, talk like you just have now?
Well, it's unpleasant to be a Fed official and talk about how you have to tighten financial conditions to push up the unemployment rate. You don't want to talk about putting people out of work. And that's not obviously the deliberate goal of policy. The deliberate goal of policy is to keep inflation from getting out of hand. Unfortunately, one of the ways you have to do that is to generate enough slack in the labor market to keep inflation in check. And that's just an unpleasant conversation to have. So what the Fed officials talk about is how we have to keep inflation in check so we can sustain this economic expansion and keep the most number of people employed. And that's true, too. What they're not telling you, though, is how difficult that is to pull off.